The first lie rich people tell you is that money is about effort. The second lie is that ownership rewards everyone equally. In real life, when a company pays dividends, most people watching from the sidewalk are not invited to the table because they were never supposed to be. This is not financial advice, this is financial education. And in 2026, with AI swallowing middle-class jobs, housing costs rising past human patience, and the Federal Reserve quietly shaping your mortgage, your credit card, and your paycheck, you need to understand one ugly mechanism that explains why the gap keeps widening. The mechanism is not magic, it is pricing, it is leverage, it is the difference between what you own and what you can realistically control. Let me start with a question you will recognize because you have heard the same story your whole life. Suppose your employer or a company you admire earns a lot of profit this year. You work there, you feel like you helped build it. The company also has shareholders, so do you get a slice? Maybe you get a bonus, maybe you get a motivational email, but dividends? Dividends are not a bonus. Dividends are ownership income. Now picture you walking into the boss's office and asking for dividends like you deserve them, not because you worked hard but because the company made money. The boss does not even need to be cruel, they just need to be accurate. They will tell you in plain language two things. First, you do not own the company. Second, ownership was not granted based on fairness. It was granted based on who had capital when the opportunity appeared. And here is the part nobody wants to say out loud. The reason rich people can demand distributions is because they bought the right to demand them long before profits became obvious. They paid a price for future cash flow. You paid with your time, they paid with their money. That is the whole difference. Your time is renewable. Your paycheck is renewable too, until it is replaced by AI. Their ownership is not renewable. Their ownership is finite, and that is why it can be priced. So why do most people never get invited? Because buying ownership in a private company is not like buying shares on a public stock market where a ticker tells you what price is fair. Private deals are priced in conversations, in negotiations, in access, and in risk. You do not just want in. You need to know what you are worth buying and what the seller is willing to accept. Most people cannot even estimate that. They are told to invest without learning valuation. They are taught optimism without mechanics. This is why I am going to talk about valuation and pricing in a way most financial education refuses to touch. We will talk about leverage and debt ratios because rich people often look over-leveraged until you understand why. We will talk about how to value a person as an income machine, not as a resume decoration. And we will connect that to why 2026 feels so rigged when the stock market climbs but real people feel poorer every month. But before we go there, I want you to remember a scene from your daily life. Think of the last time you saw a passive income ad on social media. It always shows someone with a spotless kitchen and a calm face, claiming you can build freedom. The comment section is full of hope and desperation. But then you check the fine print, and it is never a real ownership plan that works for ordinary wages. It is a funnel, a course, or a promise that assumes you can buy an asset at the right price while someone else eats the spread. In 2026, the passive income dream is even more fractured because AI-driven productivity boosts the winners while compressing the options for the rest of you. Now, let us start at the beginning, with the simplest question valuation teachers avoid because it is uncomfortable. How do you decide whether something is worth owning? Not based on vibes, not based on motivational stories. Based on cash flows you can reasonably expect in the future, discounted for the risk that those cash flows never show up. If you cannot estimate that, you cannot buy correctly. And if you cannot buy correctly, your investment becomes a bet that someone else will pay you more later. I want you to follow a concrete example. Imagine two men who look similar on paper. They have similar ages, similar starting assets, and similar debts. They even live in the same world. But one becomes expensive and the other becomes cheap. The difference is not what they currently own. The difference is how quickly they can generate income over time. Let us call the first man A. A has a house valued at $1.5 million. He has a mortgage with $1 million remaining. He has a car worth $200,000. He has a loan of $100,000 on the car. His annual income is $100,000. He is 32 years old. His income grows by about 10% per year because his industry is slowly expanding and his role remains valuable. If you wanted to compute his total assets in a simple way, you add the house value and the car value. That is 1.5 million plus 200,000. Total assets are $1.7 million. But if you want to compute his net worth, the part that would be left if he sold everything and paid off his debts, you subtract his loans. House value minus mortgage is $500,000. Car value minus car loan is $100,000. Add those, net assets are $600,000. That net number matters because it is the clean picture of what he can walk away with after obligations. And then there is another ratio that tells you whether he is stable or fragile. Debt as a share of assets. Total debt is 1 million plus 100,000, which is 1.1 million. Divide that by 1.7 million assets. You get about 64%. Now pause. In financial media, you hear people say debt is always bad and low debt is always safe. That advice is incomplete because it assumes you will never be able to use leverage intelligently. Here is the uncomfortable truth. For many rich people, debt is a tool, not a trap. They often borrow against appreciating assets to buy more assets. They do not do it because they lack discipline. They do it because their capital strategy assumes the future will reward ownership, and if they can service the debt with income, then leverage can increase their ability to compound. But for you, leverage can also become a trap if your income is unstable or if your future cash flows get cut. And in 2026, AI has made income instability feel normal. A lot of jobs that used to be secure because skills are specialized are now secure because nobody automated them yet. That is not security, that is timing. So when you see a person like A or any company that has significant debt, your first question is not whether debt exists. Your first question is why it exists and what the expected cash flows look like. Now let us move to the next man. Man B. B has the same house at $1.5 million, same mortgage of $1 million, same car at $200,000, same loan at $100,000, same net assets of about $600,000, same total assets of $1.7 million, same debt ratio around 64%. So far, it looks like a tie. But B is different because of one variable that most personal finance content ignores completely. B has a skill and a field that dramatically changes his income growth rate. B studied in a technical area with high demand. He works in artificial intelligence engineering and product development. His current income is $200,000, and his income growth is not 10%, it is 30% per year. If income grows 30% annually, the doubling math is cruelly simple. Roughly every 3 years, income doubles. After 10 years, income can be about 3 times the starting point in rough terms. After 20 years, it can become many times larger. Now let us estimate. Starting income of $200,000. After 10 years with compounding, it becomes roughly $600,000 per year. After 20 years, it can approach $1.8 million per year. Here is what the teacher in your head might miss. Valuation is not about today, it is about future cash flows and how long you can reasonably capture them. Over 20 years, B's cumulative income can be massive compared with A's. A starts at $100,000 and grows at 10%. Over 20 years, cumulative income might land around $4.2 million in a simple approximation. B starts at $200,000 and grows at 30%. Over 20 years, cumulative income can become around $20 million in a rough model. So now we are ready for valuation. If you wanted to buy the right to benefit from A, what would you pay? You consider 2 components. The net assets he already has, about $600,000. And the future income he can generate, about $4.2 million over 20 years. A reasonable valuation range for A might be future income plus net assets, between about $4.8 million and $5.9 million, depending on whether you treat the existing asset base as fully monetizable and the discounting assumptions you use. But let us inject a key psychological problem. Most people reject long-time horizons. 20 years feels too risky, health might fail. Industries change, technology shifts, the ability to earn might disappear. So you adjust your horizon. You ask for a valuation based on 10 years instead. Over 10 years, A's cumulative income might be around $1.65 million. Add net assets $600,000, and his minimum value might be about $2.25 million. Add total assets instead of net assets in a generous scenario, and you might get an upper range around $3.35 million. Now you can see the valuation logic as an actual decision, not a spreadsheet hobby. If you will only bet on 10 years of predictable earnings, A becomes less attractive because his growth is limited by his industry ceiling. If you will bet on 20 years, A becomes more reasonable, but still not amazing. Now do the same for B. Over 10 years, B's cumulative income might be around $5 million. Add net assets $600,000, and the minimum valuation becomes about $5.6 million. Add total assets of $1.7 million in a higher scenario, and you might see a maximum around $6.7 million. Over 20 years, B's cumulative income can be about $20 million. Add net assets $600,000 and you get about $20.6 million. Add total assets and you get about $20.7 million in rough terms. Here is the cliff edge. If B's income growth is real, if his industry has momentum, and if his role remains valuable, his valuation jumps dramatically compared to A, even though their current net assets and debts are almost identical. This is why rich people do not spend their lives obsessing over what you currently own. They obsess over what you can produce later. They do not ask, how much do you have in the bank today? They ask, what is the trajectory of your cash flow? How likely is it? How long can it last? At what price can I buy that future cash flow? And the most savage part is this. When people say the market is irrational, they often mean the price does not match the current narrative. But valuation is about future cash flows, not today's feelings. In 2026, you can see this mismatch everywhere. The stock market often hits highs while ordinary wages feel squeezed. That disconnect looks accidental if you only watch the headlines. It is not accidental if you understand valuation. Public markets can price future earnings growth aggressively. Tech and platform businesses can have long runways. Meanwhile, middle-class workers often face job displacement because AI reduces the need for repetitive tasks. Your employment income does not grow with productivity. It shrinks or it stagnates. So when the market rises, it is pricing a future that you may not personally capture. You do not own enough equity. You do not have the leverage to convert your labor into ownership. And the system keeps selling you the same fairy tale. Work harder, invest more, everything will work out. But what if you cannot invest because you do not understand how to evaluate what you are buying? Then your risk becomes not just financial, it becomes psychological. Because the internet sells you valuation as aesthetics, people chase the story. This business is revolutionary. But story without cash flow is just entertainment. The moment that entertainment collapses, you are left holding a down payment on someone else's future. Now remember earlier how we discussed dividends and ownership. Private ownership is rarely offered to the public at a friendly price. When you deal with private companies, you do not have a ticker, you have negotiation, you have information asymmetry, you have uncertainty about how much profits can actually be extracted and at what timing. That is why so many people never earn ownership income, not because they are not smart, because they were never taught to price future cash flows properly. They were taught to save and be patient, while other people use the early window to buy equity at the right moments. And here is where I connect this to the world you are living in right now. In 2026, AI is automating more than jobs. It is automating the ability of average workers to bargain for their value. If your work output can be replicated by software at near zero marginal cost, your income growth rate falls unless you shift into roles where humans still dominate. But most people do not get that shift in time. They get layoffs, delayed promotions, and restructuring emails. When that happens, your personal valuation changes, your long-run cash flow potential declines, your bargaining power declines, your ability to take risk declines. At the same time, the Federal Reserve's policy rate affects everyone's leverage. Higher or volatile rates mean borrowing costs rise. That hits mortgages, it hits credit cards, it hits small business lines of credit. It also hits valuations because discount rates change. The same earnings growth may be priced differently when interest rates shift. So when you hear that inflation came down, do not confuse that with purchasing power recovery. Purchasing power is a timeline problem. Your salary might be up 3 or 4%, but real goods might have shifted upward far more in the years since 2019. And even if headline inflation calms, the damage to your lifestyle can be permanent, especially if housing became unaffordable for you in the middle years. Housing is the perfect example of how valuation and cash flow expectations detach from reality. Across the United States, the United Kingdom, Canada, and Australia, home prices have moved beyond wage growth. The ratio is not just uncomfortable, it is structural. If your annual income cannot grow fast enough to match housing price expectations, you become a renter forever. And renters do not build equity. Renters pay cash flow to the asset holders. That is why wealth concentration accelerates while everyone else feels trapped. In 2026, you can also see this in insurance markets as climate disruptions rise. Floods, fires, hurricanes, insurance premiums rise or coverage disappears. That increases the cost of owning property. It also makes financing more difficult. People do not only lose money from climate events, they lose leverage, they lose ability to refinance, they lose options. So now combine these realities. AI threatens job income growth, housing drains cash flow for years, inflation still quietly punishes your lifestyle. And retirement systems remain underfunded or delayed, while Social Security ages upward for many people. The window narrows, and here is the next pattern interrupt. You might think the worst part is personal hardship. It is not. The worst part is what the system does with hardship. The system converts your stress into a product. It sells you the dream of passive income through social media. It sells you creator economy hope. It tells you you can become an influencer and monetize attention. But the creator economy is brutal. Most people make $0. The few who succeed do so because platforms concentrate reach and because advertising demand flows upward toward the largest audiences. Meanwhile, your time becomes unpaid content labor that platforms turn into profit. That is not freedom. That is work disguised as opportunity. And while you are doing that, institutions buy the assets you are promised. crypto promised escape from banks, but in 2026, regulation and custody have consolidated power. Institutional investors and regulated intermediaries hold more crypto than retail participants. Banks and investment firms earn the fees and control the rails. Retail gets headlines, institutions get structure. Even if you do not care about crypto, the mechanism is the same. Ownership and market access are concentrated, which brings us back to valuation. Valuation is not just about numbers, it is about who gets access to the right opportunities at the right price. Most people never learn to value a cash flow producing asset. They learn to chase momentum. They learn to buy after the story already worked. They learn to sell after the narrative turns. That is why their results are always worse than they expected. You need to think like a buyer, not like a spectator. Here is a more cynical example that will feel painfully relevant. Picture a 35-year-old nurse named David. He works in a hospital because he cares about people and because his skills are human. For a while, his income grows slowly, but reliably. Then his city faces insurance strain and hospital staffing shifts. AI scheduling tools optimize staffing. Automation reduces administrative labor. David still works hard, but his income trajectory slows. Raises become smaller. Overtime is cut. The hospital says it is about efficiency. David hears about buying a rental property. He thinks, I will finally escape renting. But the down payment is massive, and mortgage rates have changed based on the Fed's policy decisions. He stretches his budget. His debt ratio climbs because he must. Now David is fragile. One job disruption, and he is negotiating with lenders while his peers are getting fired or reallocated. David's story is not about intelligence. It is about valuation failure. He bought an asset without fully modeling his personal cash flow risk. He bought equity like it was guaranteed, but it was priced for a future that might not arrive for him. Now remember, A and B. David is like A in one key way. His earning growth rate is limited by structural constraints and industry pressures. In that world, debt can become a ceiling. You can increase risk to buy an asset, but if your cash flow cannot support it, your leverage destroys you. And that leads to the next ugly understanding. Debt is not automatically bad. Debt without a future cash flow engine is bad. And in 2026, AI is altering future cash flow engines faster than most people can update their plans. So let us talk leverage one more time, because it is where rich people quietly outplay you. When people say avoid debt, they often mean avoid debt when you have no certainty about future income. That is sensible, but rich investors do not avoid debt. They structure debt around assets that generate predictable cash flow. They use leverage because they can refinance, because they have liquidity, because they have income that is not tied to one employer. In your life, a credit line is often a trap because it is tied to your job stability. In their life, debt can be tied to assets and markets. Now, let's tie this to corporate examples, because the same logic applies to how companies trade. Imagine a biotech or healthcare stock that looks awful on paper. It has high debt, it has low or negative profit today. Traditional textbook logic says it is dangerous, but markets do not always price today's profit. Markets sometimes price future clinical success or future regulatory approvals. That is leverage in a different form. The investor is effectively betting that the company's cash burn will convert into future revenue at a scale that justifies the risk. It is still risky, but valuation gives you a framework to estimate risk instead of guessing based on